One of the most frequent questions I get from you sounds like this: how to trade the turtle soup strategy. Today, I will reveal all the secrets of one of the most popular trading strategies, turtle soup, and I will also run a back test. So get comfortable and get ready for a deep dive into the smart money concept. So, the first thing we need to wait for within the turtle soup strategy is the opening of the trading session. The strategy works equally well both during the London session and the US session. Moreover, there is no direct relationship between the sessions. The setup formation and its execution take place entirely within a single session. You can trade it during the London session or during the US session. You can trade both, and even the Asian session as well, if your time zone allows it. The very first task after the trading session opens is to identify the session extreme. In this example, we are looking at a long scenario, so the first extreme will be this low. Next, we need to see a sweep of this low, but according to certain rules. At this stage, we refer to the first rule of the trading strategy. The range of the fluctuation of the updated low must not go beyond the FIBA 1.5 level. What does this mean? We take the Fibonacci grid and stretch it from the previous low to the end of the corrective wave. In the settings, we select these specific parameters and leave only 0, 1, and 1.5. After we apply the Fibonacci grid, our updated low must remain within the Fibonacci range from 1 to 1.5, and must not break outside of it. That is, if in this case we had pushed significantly deeper, we would not trade this pattern. But in our example, we will take a pattern that meets our requirements. This 1.5 level does not carry any kind of magical property. It is needed so that we can filter trades and avoid ending up in a position against the main order flow. In other words, we only need a small sweep of the previous maximum. After these conditions are met, our task is to identify an order block. In this case, this candle will act as the order block. From it, we will enter a buy position with a stop below the base of the order block and a take profit of 1 to 3. I think this is clear, so now let's talk about the number of attempts to enter this position. If the first attempt does not result in a successful trade, for example, if price breaks through the order block and prints a new low, it is worth trying to enter the trade again. However, if you take a profitable trade on the first attempt, we do not trade this setup again within the same trading session. And even in the case where we had a low and there was a setup here, but for some reason we were unable to enter the position, for example, a clear setup did not form or price did not reach the order block and our order was not filled. If price moves away and starts probing the opposite boundary of the trading session, then it makes no sense to look for this setup there, because if you try to trade this pattern in a mirrored way, you would be violating the entire logic of this strategy. The idea of the strategy is that, as a rule, at the beginning of the trading session, price makes several manipulations in order to trap market participants into positions, and only after that does the true move unfold. It is precisely the compression of stop orders that becomes the boost for the true move. This is point 3 of the current trading strategy. Therefore, as a rule, this pattern forms within the first 2 to 3 hours of the trading session, and trying to trade it in the second half of the session would be a mistake. And the final point, as a time frame, we will use the 5-minute chart, and to refine the order block we can switch to the 3-minute chart or, alternatively, to a higher time frame, such as the 10-minute chart. The short scenario is traded in a similar way. We have the high of the US session, after which we see a sweep above the US session high that remains within the range from 1 to 1.5. After that, we mark the order block and place a pending limit sell order. However, in this case, our order would not have been filled. Now let's run a back test of the strategy on historical data to make sure it actually works. We have a high and we have a low, but there is no formed pattern yet, because here is our high, here is another high, and here is our low. Our task is to wait for a sweep of one of these extremes. Let's keep watching. We get a new low, and if we stretch the Fibonacci grid, it becomes obvious that price has gone beyond the boundaries of our zone, so this pattern does not suit us. We move on. But this sweep already fits our criteria. We stretch our Fibonacci and understand that this pattern is suitable for us. The next step is to identify the order block. Obviously, it will be this large candle. We keep watching. Accordingly, we place a pending buy order, right here, with a risk-to-reward ratio of 1 to 3. Let's see what happens next. Price takes our order and stops us out at the stop loss. Perhaps it would have been reasonable to stop here, but for some reason, I believe in this strategy, and I am confident that it will still show us its potential. So we move on. The US session has started. We have a high and we have a low. Now, our task is to wait for a sweep of one of the extremes. Here we have the first low, after which we see a sweep. If we stretch the Fibonacci grid here, we will understand that this trade does not meet our requirements, and we did not get another sweep of the low. And I remind you that we do not trade this pattern in a mirrored way. Therefore, trading during the US session is finished for us. We scroll the chart to the beginning of the London session on the next day. The London session has started. We have the first high. Then there is a sweep that does not meet our requirements. There is another sweep, and this pattern already suits us. Here, I would switch to a lower time frame in order to more clearly define the order block. This candle will be our order block. And by the way, on my channel there is a video about how to properly work with an order block and how to identify it. I will leave the link in the description of this video. Be sure to watch it. This is one of the most important topics in the smart money concept. We mark the order block and return to the 5-minute chart, and we place a pending order with a 1-to-3 ratio. Let's see what happens next. Price takes our order, tests the order block once again, and eventually closes at take profit. The trade is completed, and we no longer consider trades within the London session, which means we move on to the US session. Here we have the first low of the session, then comes the sweep. Here, even with the naked eye, it is already clear that this trade does not meet our requirements, since it goes beyond the FIBA 1.5 level. So we move on. But here, it starts to get more interesting. Once again, we take the Fibonacci and stretch it from here to here. It is obvious that this sweep suits us. Therefore, I mark the wick of this candle as the order block and place a pending order. Then we watch what happens next. Our order gets filled. The order block is tested many more times. Eventually, the trade is closed at stop loss. However, at the same time, a new pattern has formed. And since we are allowed one re-entry into the trade, we will do that. We stretch the FIBA from the last low to the end of the correction. The sweep remains within the marked zone. Therefore, this pattern suits us. I mark the wick of this candle as the order block and place a pending order. Let's see what happens next. Already on the very next candle, our order is taken and the trade is successfully closed at take profit. At this point, we are done with the US session and scroll to the beginning of the London session the next day. The London session has started. We have the first low. Now we wait for its sweep. We get a sweep. We stretch the FIBA. This trade suits us. Therefore, we mark the candle's wick as the order block and place a pending buy order. The trade is essentially already filled. Let's see what happens next. This trade closes at stop loss, but in doing so, a new pattern forms. Now we stretch the FIBA from this level to the end of the correction and realize that this pattern also meets our requirements. Here, in order to correctly identify the order block, I will switch to the 3-minute chart and mark this liquidity-taking candle as the order block. We return to the 5-minute chart and place a pending order with a 1-to-3 ratio, and then watch what happens next. Our order is taken, and it closes at take profit. Within the London session, we will no longer take trades, so we scroll forward to the US session. Here, a new low is formed, and we wait for a sweep. There is a sweep. We stretch the Fibonacci grid to make sure that this pattern suits us. It does. But in order to highlight the order block, I will switch to the 3-minute chart and mark the wick of this candle as the order block. We return to the 5-minute chart, place a pending order, and then observe how price behaves. Price takes our order and closes it at take profit. The trade is successful, so there is nothing more to do within this session, and we move on to the next day. The London session has started, and we immediately have a high. Now we wait for a sweep of this high. If this candle had not belonged to the London session, we would have had a pattern formed here. But at the current moment, the session low is here, so we keep watching. We get a sweep of the high. We take the Fibonacci grid and stretch it from the previous high to the end of the correction. And we realize that this trade does not suit us, so we ignore it. But the situation is interesting in that even such a pattern would have worked. If we had taken this trade, for example, I would have marked this entire zone as the order block. As we can see, we would have had an execution here, this trade would have been successful. But let's rewind back to this moment. And how comfortable would you be entering a short position after such an impulsive move? Personally, I would feel extremely uncomfortable entering a short position under these circumstances. This is exactly why we need this Fibonacci level, to filter out trades like this. And in this particular case, the trade could have turned out quite well. But in practice, this filter will save us many times. And now the New York session has started. We have a low, and we have a sweep of this low. Here, I won't even stretch the Fibonacci. It's obvious that this trade does not suit us. We get another low. And now we wait for a sweep of this low. We get the sweep and a bounce. We stretch the Fibonacci. And yes, this trade suits us. Therefore, we mark the order block and place a pending order. Here, price fell just a little short of our order. So this trade was not filled, although it could have turned out quite well. Let's see what happens next. If we get another sweep of this low, we will try to enter the trade again. For now, I delete this trade. No, the US session has ended. We move on to the next day, to the start of the London session. During the London session, we have a low and a sweep of this low. But it is obvious that this trade does not suit us. Let's see what happens next. And now we wait for another sweep of this low. But this only happens during the US session. So during the US session, we have a low and a sweep of the low. It clearly suits us. And I mark this large black candle as the order block. Let's see what happens next. Price takes our order. But I forgot to place the order. Price tests our order block several more times and, of course, eventually closes at take profit, literally by half a pip. In this way, we tested this strategy over the course of a week. In total, we ended up with 8 trades. 3 of them hit stop loss, and 5 hit take profit. The win rate of the strategy came out to 71% with an RR of 1-3. In my opinion, these are very, very good results. There is definitely something to build on. So take this into your toolkit, and I'll see you in the next videos. Bye!